They have been, and as you know, a massive pipeline of IPOs typically comes at closer to the sort of, I don't want to say tail end, but sort of second half of it, or the last quarter of the bull market as such, right? Because there's no appetite. So I think there's some risk, although the quality has begun to improve a little bit versus what we saw last year, and particularly first half of this year, right? It was extremely frothy. So I think quality has begun to improve. But yeah, in fact, the question is next year looks like the IPO pipeline will probably begin to dry up a tad as the volatility picks up.
And as an investor, what do you make of the whole argument of valuing these companies and price to sales? For somebody who's constantly looked at valuations as a price to earnings metric or any metric which is so linked to the financial performance of businesses, whether it's EV per EBITDA or the likes, what do you make of price to sales and that driving up valuations?
I think it's an important question, because if you look at the last 10 years, I think primarily because of some of the SaaS names and Amazon, so on and so forth, it became rather convenient to value and price to sales businesses that the assumption was they will become profitable over time, and they're just investing in the business, hence they're not profitable today. I think if you look at vast majority of them, there's basically no hope of them ever turning in a profit. And as you're seeing the air begin to come out of that bubble, particularly it peaked in February, but in the last month and a half. And I think we may still be in early days of those. So if you look at companies in China or in Brazil, obviously in US, in Europe, a lot of those names have really, what seemed like hit hard. But nevertheless, I think there could be significant downside. On the other side, if you look at folks, companies that are profitable on a net earnings basis and cash flow basis, there's just a better support. So I think this is more a normalization. And again, that is a function of easy money. This typically happens when the Fed has easy money and the tap is begin to close.
If you believe that non-profitable tech and that bubble has burst, if you believe that they might even be early in their downward journey then, Rajiv, at what point would it start looking like worth a nibble, and how would you know?
Yeah, so the reason why I'm saying early is because you have not seen mass exodus of employees, because if you look at a lot of tech names, in fact, one of the things which is remarkable is people aren't talking about the wage pressure on the tech side. And the reason the wage pressure is sort of a little bit, it doesn't show up as cleanly as it does in other businesses, because they use pro forma numbers, right? So they show below the line conveniently stock comp, which is sort of excluded. The problem is if the stock doesn't go anywhere, employees will ask for cash, right? Because the stock is not going anywhere. And that's a sign that we're in the middle or late part of the crash, because when employees start panicking because the cash composition is low and the stock is not going anywhere. But I think we are very early in that. We have not seen any sort of mass exodus from some of the more frothy names because the stock is down.
And of course, tech is a catch-all phrase, isn't it? I mean, it's an absolutely vast umbrella under which there are many different sectors, including the chips. And I'm going to bring up Micron, which is one of the reasons why Wall Street was so cheered overnight, because essentially they said that they're more confident that the chip shortage will ease next year. And of course, one of the other reasons we saw Wall Street higher was outside of tech, Nike saying it's more confident that supply chain issues will ease next year. If indeed this is true, supply chain issues and chip shortages could be better in 2022. Are there any stocks or particular sectors that you think would be worth buying now that could take advantage of that?
It's actually very slim picking on the traditional tech. Some of the e-commerce names, obviously large e-commerce names, which are free cash flow positive, are beginning to look a little bit more interesting. But if you look at the Chinese names or some of the Korean names like Coupang, I think their model is being tested. Not to mention some of the regulatory risk has begun to show up. Like for example, you've seen in Coupang. So it's not simply China where you're seeing regulatory risk. You've seen Italy begin to put on fines on Amazon, for example. So it's too early to be aggressive. Some of the names we like on tech, I mean, those are the FANG type names which are still very profitable, very sensibly valued. They're not excessively valued. I think those are fine. But the second tier where the froth was the greatest, I think that's where the risk tends to be.